Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets of the corporate world. And let me tell you, you will want to decipher this one. Bolt Projects Holdings Incorporated, a company trying to create sustainable materials, has dropped its latest filing, and it is a story of soaring hopes and some serious financial headwinds. We're diving deep into the numbers, the risks, and what it all means for their future. Before we jump in, if you're looking for clear, no-nonsense analysis of how companies really work, make sure you're subscribed. And hey, if you want to chat about this stuff and get more exclusive content, join our Discord community, linked in the description below. Alright, let's get straight to it. This filing is a registration statement, meaning Bolt Projects Holdings Incorporated is getting ready to potentially sell more stock, or is giving a heads up about existing shares being sold. It is a look under the hood. The main event here is a plan to sell up to almost 20.1 million shares of their common stock. Now, the company itself is INST selling these shares directly and 1T get the cash from it. This is coming from a stockholder named Ascent Partners Fund LLC, or Ascent, who might sell shares they previously got from Bolt. Bolt is basically registering these shares so Ascent can sell them on the open market. Bolt might get up to $20 million from Ascent in a separate deal called an equity line of credit, which sounds like a flexible way to raise money. Bolt S stock is already out there, trading on the Nasdaq under the ticker BSLK as of the 25th of September 2025. It was trading at $3.96. But here is where things get interesting. Even though they're relisting, they're retelling us they're an emerging growth company and a smaller reporting company, meaning they get to follow slightly less strict reporting rules, which sometimes makes their financials a bit harder to compare to bigger companies. Now, they very clear about the risks involved, and they start right on page 7 with a whole section dedicated to it. This is always a big red flag saying, hey, pay attention, this stuff is risky. Let's look at the big picture. Bolt's mission is pretty noble, to create sustainable materials and lead the way to a brighter future, benefiting both people and the planet. They started with a strong scientific background, inspired by things like spiderwebs, aiming to replace harmful materials in things we use every day. Their main product is this vegan silk technology platform, which currently includes things called B, Silk, and XL. Silk, these are biodegradable ingredients for the beauty and personal care market, meant to be a better alternative to silicone. They've been working on this for a while and have invested over $300 million in research and development. Now for the tough part, Bolt has been losing money. A lot of money. They lost $65.4 million in 2024 and another $10.5 million in the first half of 2025. Their total accumulated deficit, which is basically all the losses added up since they started, is a staggering $472.3 million. This is a classic case of a company investing heavily in the future, but it is not paying off in profits yet. Let us go back to this equity line of credit, or ELOC, with Ascent. On the 12th of September 2025, they set up this deal where Bolt can sell up to $20 million worth of their stock to Ascent over time. Ascent has to buy the shares at a price based on market value, but with some conditions. For instance, Ascent won't buy shares if the stock price drops below $1, or if buying more would give them too much voting power in Bolt. This is a common way for companies that need cash but can get loans easily to get some funding, though it can also lead to the stock price taking a hit. Remember that Nasdaq listing. Well, they've also received notices they might not meet the requirements to stay listed, specifically about the minimum market value of their stock. They're appealing this decision, but there is no guarantee they'll stay on Nasdaq. This is a huge deal because being delisted can make it much harder for investors to trade shares and for the company to raise money. Okay, let's dig into those risk factors. These are the things that keep management up at night and potentially investors too. The first big risk they mention is that their ongoing losses and negative cash flow cast serious doubt on whether the company can even keep operating. This is the going concern warning, a very serious statement that means they might not be around in the next year without significant help. They explicitly state their current cash isn't enough to last 12 months. They also worry about not generating enough cash to pay back their debts. This is a critical point. If a company can't service its debt, it can lead to bankruptcy. And again, they reiterate the point about not being able to become profitable. This isn't just a bump in the road, it is a fundamental challenge they're facing. That Nasdaq delisting risk, they mention it again here, emphasizing that without a successful appeal, they could be kicked off the exchange. Their entire business hinges on this vegan silk technology platform. If that doesn't take off, the company struggles. They're not diversified. This is crucial. They found material weaknesses in how they handle their finances. This means there are significant problems with their internal systems that could lead to mistakes in their financial reporting. If they can't fix these, it erodes investor trust and could mess up their stock price. Back to that going concern warning. In their financial statements, they've explicitly noted this substantial doubt. They'll need more money, possibly from selling more stock, which means more dilution for existing shareholders.